My name is Prakash Singh. I'm a licensed realtor and a mortgage broker. I have been in real estate for much over a decade. Like I have been a realtor for 13 years. I've been in real estate for 15 plus years. And I have been a loan officer for 4 years, more than 4 years now. And recently I have opened up my own mortgage brokerage. So I can help people on both sides of the deal, whether it's purchase or finance. And at the same time, with being in this industry for so long, I have been, I have a very good idea of inspections, appraisal, and other stuff. So I try to help people. But main goal of today's webinar is to make sure people who are attending or whoever is watching it online, they have clear understanding of the process and they know what they are getting into, what kind of questions they have to ask, and how to go about it. Okay, I just got a message that my voice is breaking. Let me make sure. Let me try to go a little louder. Is it better now? I hope this is better and everybody can hear it. Let me see. Okay, I will. I hope it's better now. So let me start again. So main purpose of this webinar today is to make sure you guys are aware of the process and you know how this whole real estate purchase works. And at the same time, if you are working with some professional like me, like if you have your own realtor, if you have your own loan officer, you know what kind of questions you should be asking. And no matter whether you are working with me or wherever, if you are attending this webinar, you should be able to understand the process and you should get something out of it. Okay. So let me go to the next slide. I hope my audio is better now. Just one sec. Okay. So what am I going to cover today? I will be covering financial preparation. How do you prepare yourself before you purchase? Your loan options, what kind of different loan options that you are going to have, your home buying process, investor strategy, in case if you are planning to invest in real estate, what should be your strategy? I will be covering it at very, very high level, but very soon I am going to schedule another webinar where I will go through all kind of different investment options and investment loans. Then the mistakes to avoid, and at the end I will go through the clear action plan that you should have when you are planning to purchase a property in Minnesota or wherever in USA, basically. Okay, so the first thing is whenever you are planning to purchase a property, you have to have a good credit. Like if you are going to take a loan, if you are buying it cash, that's a different story. But there is a credit requirement, and that varies depending on what kind of loan you are applying for. So there are like basically two types of loan which are most popular in US. One is FHA and second is conventional. Most of the people with good credit and good income, they go with conventional. But FHA is another option which is backed by government. And this gives you a little bit of flexibility in down payment and even with credit scores. If you have a lower credit, you had some issues in past, FHA can get you a loan for 580 plus credit score with 3.5% down. There are other areas which needs to be considered because FHA comes up with another insurance on top of what you are paying as mortgage insurance. So there are like some caveats that we can discuss in detail if you call me. But Conventional is more what you see normally in market, where your credit score has to be 620 plus, and you get very good pricing if your credit is better than 740 or 760, and if it is 800 plus, then it's even better. Why I am talking about it first? When you are planning to purchase a property, when you are in the market, I would recommend go to a loan officer, try to get your credit pulled. There are two different ways to pull your credit. One is soft pull, one is hard pull. If you are scared of getting your credit, like if you're scared of hard pull and you think your credit may go down, it doesn't really happen that way, but still, you can always ask for a soft pull, and you can look at your finances. Your lender will be able to see where you are, how do you stand, and if there are any issues, then they will give you a clear path to fix your issues. Like recently I had a client, he was thinking his credit score is 750. When I pulled his credit, it was around 686, and he was not getting the interest rate that he was looking for. I have some partners, they do credit repairs for free for my clients. So I while parallelly I have started his loan process, I reached out to one of my credit repair partners, and they were able to bring his credit back up to 747 before the closing took place. So he got a better deal. He was putting only 7% down, so he got a good deal in his mortgage insurance. That also came down when his credit went up. So it's always a good idea to look for your credit, check with a loan officer before you proceed with your purchase. I hope my audio is still clear and no issues, but if you guys do, please shoot me a text or let me know on this message. Let me check. Okay, so we are good. Now this slide is just to show you a little bit of comparison of how this whole down payment works. So suppose you are planning to buy a house of $400,000, and I can get you a house if you put 3% or if you put 50%, right? So 3% is what I recommend. There are some programs where you can put 1% down and you can still own a house. If you are a VA, then you don't have to put any money down. For FHA, 3.5% is what they require. So depending on which plan you are going with, if you are a veteran, then 0% is the option. That's a very good option. You or your spouse, if they are a veteran. Otherwise, conventional is 3% to anywhere 20 plus. Why did I mention 20? So there is a small component that gets added into your mortgage payment. It's called mortgage insurance. If your total down is less than 20%, then you will have to pay that mortgage insurance, which is like for a $400,000 house, it will be somewhere around, depending on your credit, it can be $75, it can be $145. So that much extra money you will have to pay per month until you reach that 80% loan to value, right? So this is one that you need to consider. If you are buying a $500,000 house and you are getting almost same interest rate by putting 5%, then you may have to pay $100 extra for your mortgage insurance. But if you have a better plan and you can use that 15% money and get more money out of it, like that kind of financial planning you can do, whether to put 20% down or put only 5% down, and make use of your money. So it all depends on your interest rate and a lot of other factors. Okay, I have a question from, let me note it down, from John. Okay, what if I put 10% down? Okay, so there's no harm in putting 10%. I'm just taking these two numbers, 5% and 20%, because if you are not putting 20% down, you are going to pay mortgage insurance anyway. If you are putting 5%, then also in my situation, I can get you almost the same interest rate. Only additional money that you have to pay is your mortgage insurance. So So paying that 5 extra percent and making it 10 will help you with your lowering your payments, but it's not going to help you with your mortgage insurance. So that was the reason I was taking these two numbers, 5% and 20%. Now, if you have 10% saved and you want to put it in your house, that's good. It will reduce your monthly payment. A lot of people, what they do, they put only 5% down. They take that 5%, like in this case, $400,000 house, they put $20,000. They take another $20,000. They put it somewhere in stock, 401k, wherever they can get better returns. So that's your decision, basically. Or maybe you can sit with your financial planner and you can talk to them. So for me, it's 5% or 20%. In between, you have to pay your mortgage insurance. These 3% options are there, but they come up with a cost. So your interest rate may go higher. A lot of other factors also play. So that's why I'm focusing on these numbers right now. I hope that answered your question. Let's go to the next one. Next is a lot of people don't understand, but it's a very, very important concept that's called DTI. So it's a debt to income ratio. So how much is your monthly debt and what is your monthly income? That's how it's calculated. So debt divided by your monthly income, it should be 45 or 50% or less for conventional. It can go all the way up to 56.9% for FHA. I have not mentioned VA here. VAs get little bit of flexibility, and depending on like what their situation is, a lot of lenders can provide some better, very, very good deals. So now how it is calculated. So this is a very, very big area to cover. There are a lot of factors in calculating DTIs. You may think your credit card bill is $2,000 and you are making $4,000, so your DTI may be 50%, but that's not the case. Like for one example, if your car loan payment is like, if there are less than 10 loan payments are left, then that's not added to your DTI. If your monthly credit card, maybe you owe $3,000, but your monthly minimum is only $50. So that will help you with a higher, with a lower DTI basically, because they only care about your monthly payment. So even if you qualify with your DTI, you should not be happy first. First, go and talk to your lender and whoever is your financial professional and ask them how it was calculated and how much room do I have. It doesn't mean that if you make $4,000 and your mortgage payment is $2,000, it is possible that you may get qualified. But if you buy a house and pay mortgage $2,000, then you have your electricity bill, your utilities, your other payments, your car payment. You might not have enough money left for survival. So DTI is an important factor. Make sure that it's less. And other thing is you understand your DTI and talk to your professional. Okay. I think I have another question. Let's see. Okay, this question is from Amit. So, hi Amitji. Okay, so what should be a good DTI to purchase a property? If you ask me personally, I would say 25%, because if you are making $100,000, government is taking 30,000 out of it, right? So in hand you are getting 70, or maybe whatever is your tax bracket. And then if your total mortgage payment itself is $40,000, then you are left only with 30 more thousand per year, which might be difficult because you have to, these DTIs normally don't add all those other factors which are like your kids' summer classes or some of those utility costs which goes up some few months and of the year. So it's always better to keep it at 25%, max 30%. Okay. I have seen a lot of people going by 1/3 rule, 1/3 for the mortgage, 1/3 for government, and 1/3 for family, something like that. So you can be in that area. I hope that answered, but if you want detailed analysis, you can always call me and we can look at I can look at your finances and I can try to help. Although you should reach out to some good financial advisor or person who does this on daily basis, and they should be able to help you. Okay. Thank you. Okay, so that was about mortgage. Why did I cover mortgage first? Everybody thinks I have to buy a house, I should start looking for it. But I'm saying it's not like that. It's different. You should be first looking at your finances. You should understand your monthly payment. You should make sure that you are ready for it. Then you go look for a house. You can look for a house online all day, but when you are really out in the market and looking at a house, you first need to understand your current situation. You need to understand how much you can afford. Based on that, make a plan, and that's when you should go out. So since I'm a realtor as well as I'm a mortgage officer, I sit with my clients and I make sure they understand their monthly payment, how much money they have to put down, how much money they have to pay every month as mortgage. And then based on that, we make a decision. Okay, you should go for a $300,000 house, or you should go for a $350,000 house, right? So here is the process that I have defined. So the first one is define your budget range. For that, if you have to sit with some professional and do all kind of maths, just do it, or talk to your realtor or your mortgage officer and come up with a budget, like a range at least that I can afford from 350,000 to 400,000 based on my credit, based on my income, based on my expenses, right? Second is choose a location. That's very important. I live in Minnesota and I meet with people, they say 20 minutes from downtown. That's not something that you should be coming up with when you are looking for a house. Just look at all the areas which are 20 minutes and then come up with some location, because 20 minutes north of downtown may cost you 300,000, 20 minutes south of downtown may cost you 400,000, right? So there is a big difference in payment. One may cost you $1,500 per month, one may cost you $2,000 per month. So it's always a good idea to go look at the areas, look at school districts if that is important to you, and come up with a solid plan. Come up with something like, okay, I want a house in Wayzata school district, or I want to be near Wisconsin border. I want to be in the south of the metro. Like those kind of things you should be coming up with. That will help your real estate person, and it will help you expedite your process even further. Like you see one house for 300,000 in one area, suddenly another house pops up at 250 in other area, so you will be jumping around and you will be missing. It's a very good chance that you will be missing some opportunities. So finalize your area first. Then, okay, I have a question from Lakshmi. Okay, how do we decide which school district is good? So as a professional, for me, all school districts are good. But there are some good websites like niche.com, NICHE, there is a greatschools.org. You can go to these websites and they have a very good criteria and they have some kind of grading and ranking system. And if not, you can contact me after this call. I will send you those websites, and you can have a detailed look of which school is good. If your kid is going to elementary, which is elementary, what is their rank? They have all kind of details. Their student ratio, teacher, all those things that you need. Their math score, English score. So that is how a lot of people make decisions. Or else talk to a friend who recently bought a house. They might have done some research, so they can help you too. Okay. Thank you for that question, Lakshmiji. Next is evaluate taxes and homeowners insurance. So, sorry, homeowner association. So in case you are buying a townhome, most of you know that there is a HOA involved. If you are buying a condo, there is another HOA, but that even comes with a higher fee. So look at and this is what I was talking about. When you talk to a professional, first time they may say your principal and interest is $2,000, but that's not it. Your HOA could be $450. Your taxes, the way they are going up, that could be $300. So suddenly your mortgage payment changes from $2,000 to $2,750. On top of it, there is a homeowner's insurance that is another $100 to $200. So when you did your calculation, you thought, oh, I'm going to buy this house, I have to pay $2,000. That's what was showing up in your DTI too. But when you enter the house, your monthly payment is $3,000. So that's a big jump. So always evaluate your taxes and your homeowner association first. Insurance is another thing that you should be evaluating, but that doesn't change much unless recently it changed a little bit. But yeah, so consider all these factors and then work with experienced realtor who knows the area, who understands your situation, and who is there, who is willing to work with you, and who is there all the time when you have questions. Like in my case, you can always text me in the night or in the morning, or I don't mind you if you have a question while you are sleeping at 2 a.m. in the morning. You can always send me a text that, hey, Prakash, I have this question I forgot to ask you, and I will respond in few hours as soon as I see the text. Okay, and you can call me whole day. Let's go to the next one. So this is where a lot of people have questions, realtor contract. So first, when you go to a realtor, you have to sign an agreement that you want to work with them. Okay. And you have to define, they will be going through their contract. They will explain you all their duties and compensation, and they will clarify on any kind of fiduciary responsibilities that they have. I know most of you, whoever have bought the house, most of you guys have not gone through the agreement. You guys don't know what is the fiduciary duties that a realtor comes with, and what kind of compensation and duties that they have. You guys just, okay, my friend used realtor XYZ, and you just go and you go with that realtor. But that's not the case. Like in my case, I go through each and every line of the contract, and I make sure that you understand. There is a clause where if seller doesn't pay, and if realtor has completed all their job, then you might have to pay to your buyer's realtor. Buyer's realtors are considered free, but they are not always free. In case of any problem happens, then who will be responsible? What is your duty? What is your realtor's duty? You need to understand that before you sign a contract. Okay, so next time when you are with a realtor, or even if you are with me, always ask, hey, what are you asking me to sign? How does it work? What will happen if things go wrong? Okay. I have another question. Let's see. It came up here. Okay, this question is from Roberto. Okay. Hi, Roberto. So, do we have to sign it before we see the first house, or do we need to sign it before we put an offer? Okay. So, legally, actually, some rule has changed 1.5 years ago. So a realtor cannot show you a house until they have a written contract, and this will help you too. See, for realtor, you are in contract means you are serious, you want to work with them. For you also, the person you are going with, you are going to some unknown places, they have a contract with you, so they will work for you. It goes both ways, right? And on top of that, they cannot show you a house, that's the new rule, without a contract. I know some of them are showing maybe on their personal capacity, but in that case, they are covered. If anything bad happens on that property and you are with a realtor and you are not in a contract, then you are not his client, right? So in that case, if anything happens, like any kind of accident happens on the property, you are not covered. Realtor is covered because he was there. In this case, he also might not be covered, but at the same time, you are putting both of you guys in problem. So it's always good to go in a legal way, get your contract signed, and then proceed. Okay. Let's go to the next. Next step is your offer contingencies. You will be surprised, a lot of people don't know about all these contingencies. And I make sure that my clients know about it. They make a formal and educated decision before they proceed with the offer. Okay. So when we submit an offer, we have to put earnest money. Within 2 working days, we have to provide that earnest money to to the seller's agent or to the escrow company, whatever they have decided. Now comes few contingencies that you need to know that should be there in your purchase agreement. So one of them is inspection. I think most of you know about inspection contingency. It goes from anywhere from 5 days to 10 days. You bring your own inspector, they do inspection. Based on that, you negotiate or however. But during that period, if you face any issue, you can cancel your contract. You can cancel the purchase agreement. Second is financing. Financing also goes in couple of ways. So before closing, if you lose your job or if you're not able to get the financing, then you get your earnest money back. Sometimes they give you a certain amount of days that within 18 days or 20 days, you have to come up with a commitment letter. If you can't get a commitment letter, then you are off the deal. So here, people who work with me and they use my mortgage services. So I try to get them the letter within 2 weeks. And at the same time, I make sure that their sellers are informed, and we make sure that sellers feel happy about the client. So we send them updates on time to time, and we provide them all kind of information that they are looking for. So they also feel confident. In that case, if we are not able to give them commitment by the certain amount of days, still I bring I talk to them and I build a nice repo that they don't mind if there is a delay of a day or two. So that also depends. Like with as an experienced mortgage officer, I know how to deal with those kind of situations. Next is appraisal. Everybody knows appraisal needs to be done, but how can this be a contingency? You'll be surprised. Very few people know about it. So when you put in an offer, you need to put in additional column, and in some states it's there as part of their purchase agreement. But in Minnesota, you have to put some additional columns, that additional rows you have to add, and you have to mention that this property should be appraised by a certain amount, and if it is not, then buyer will have right to cancel. So that is how it's played. And sellers don't like this kind of contingency, but this is to secure our buyer. So when appraisal happens, you pay for appraisal, and suppose a house was listing price is 400,000 and appraisal is 380. On good faith, some of the sellers may consider reducing the price, but legally they are not if there is no contingency. So you have to put this appraisal contingency in your purchase agreement, and you can either cancel the deal, come out of the deal, or they will reduce the price. So this is a good thing to have. Okay, I have another question from, let's see. Okay, this question is from Jamal. How many days it takes for an appraisal? Okay. So nowadays, for last few months, you see that inventory is low. There are not a lot of homes selling. So I see same day or next day appraisals. As soon as you put a request, it goes to a common portal where appraisers from all over the country, they are there, and local appraisers normally pick up that request, and they are doing it within a day or two. They are providing their report in 3 to 4 days. But normally we keep a week or two secured for appraisal, but it's happening at much faster rate. And for a single family, it's costing around $600 to $650, depending on what kind of lender you are using. And for investment, there is an additional rent schedule that you have to add that goes for $180. So your investment appraisal could be somewhere between $780 to $820. So that's how it works. There is no fixed price because it depends on which appraisal company has picked up your request, and their fee may vary a little bit. Okay. Oh, yeah. Inspection. So first of all, I will request all of you, no matter you are buying a new construction house or you are buying a pre-owned house, always do inspection. Okay, in new constructions, people try to avoid inspection, but here is my experience that I had. So in new construction in places like Minnesota, which is very cold, it is very well possible that there are minor cracks in your foundation. There are some cracks in your pillar, which will get bigger and bigger as if it is not addressed right away. And by the time snow melts, you will see that there is a big hole in your basement wall. So always get that inspected. They will look at your air purifier. They will look at your all your mechanicals. So they will have a very good understanding if something is wrong. It will cost you $400 to $500, but if they find one problem, that will save you thousands of dollars. So it's always good to do inspection. And once you have that proper inspection report, it gives you power to go back and negotiate with sellers. Because if you are just going by yourself with your own visual inspection, seller might not take you seriously. But you have a report from a qualified inspector, so definitely they have to listen to you. So that's why I recommend inspection. Okay, let me see. I have another question. Okay, this question is from Baljit. Can I do my own inspection? I mean, that's the point of calling a professional. You can always do your own inspection, but like I said, if you provide a report in email that I saw a hole, I saw something is breaking, that is not something that sellers will negotiate on. But if it comes from a professional, it's very difficult to say no, because particular inspection company has mentioned that in their report. So that kind of becomes legal. I'm not saying what you do is wrong. You can always do that, but I personally don't recommend. But yes, you can always go back and say, I did my own inspection and I don't like this. Okay. Okay, next one that a lot of people miss, and I will not let my clients miss this. You get a set of association documents, and in Minnesota, you have 10 days to read the document. People see those big documents, and then after that, they get scared, they miss it, they get busy in some other stuff, and they never read those documents. You need to read all your association documents, especially the rules, their finances, their reserve study. You have to read those documents. Okay, I know you won't understand. Okay, that's fine. You have your realtor, ask him. If realtor is not responding, realtor is busy, he's somewhere out in his family function, talk to your loan officer, send them the document. Like a person like me who has real estate background, I can read the documents and I help my, even if you are not my real estate client and you come to me for mortgage, I will read those documents for you and I will make sure that you understand. Okay, you need to read all the documents. You will get a big set of documents from seller. So, and you have 10 days. And the beauty of this document is you can cancel your deal even if you don't like a single line in all those documents. So within 10 days, you can cancel for any reason. So in case of associations, in case of townhomes, you get this extra power to cancel your deal within 10 days. Okay. Okay, I have another question. Let me see. Okay, this question is from Shanmukha. So the question is, what if we don't understand something in that association docs? Who should we reach out? Means you can, if your a realtor doesn't understand, your mortgage officer doesn't understand, you can always go back to seller and try to get some clarity. You can call association company. They are pretty good at explaining. And some of the association companies don't have a good phone number or a person to talk to. So ask your seller to provide you uh, the actual property manager's number. Call that property manager and ask about that particular line that you did not understand. And at the end, if nobody could explain it, then talk to some attorney. That's the last hope. But somebody should be able to help you understand what that document means. And if you already have that situation going on, you can always send it to me. I will read and I will see if I can help you. Okay, here comes another part which people skip. Most of the time, I've seen the reason is your realtor is busy. It's the last day. You are also excited to get into the house, and means you are so excited that you miss it. Basically, final walkthrough is people think, okay, house is beautiful, it's in good neighborhood, what can go wrong, right? But you went and you saw $1 million house. You saw a $100,000 bed in that house. You saw a big jacuzzi. You saw some good, nice flower plants, everything in that house, and you thought, okay, this is your dream house. Now you don't know what is behind the wall. Maybe his kid a few years ago he made a hole in that wall. Maybe the bird that ran out of the cage or flew out of the cage, she might have broken one of the pieces in one of the kitchen areas or somewhere, or one of the tile was broken which was behind the uh, air fryer. So when everything is moved out of the house, or at least ask them to move them towards the middle of the room, and then you should go and check all the walls. See, minor scratches we all understand, right? But if there is a hole, if there is something broken, it's you should look at it. And there is nothing, means you are, it's not late, it's never late. The day you are going to sign, you can always go back to seller and you can ask them to fix all those repairs or put some money in escrow. Escrow is a place where money is kept. It's a common place. Your closing company or your lender will hold it, and until that repair is done. So suppose suddenly on the last day you found that something is broken that may cost you $2,000 to $3,000. Ask your seller to put $3,000 in the escrow. Get it fixed. If it is fixed only for $2,000, then return $1,000 back to the seller. So that is how you should be doing. But normally what happens is everybody is sitting on your head. Your lender is saying, sign the document. Your realtor is saying, we have only 10 minutes to close. And you feel pressurized and you think, okay, let me proceed. But no, don't do that. First of all, I won't do that to you. But if somebody is putting pressure on you, don't do that. Uh, Sign your documents only when you are fully satisfied. If it is $100 or $200 issue in $1 million house, I will say you may leave it, but it's up to you. Okay, so you verify your property condition, you confirm no new damages from the day when you saw the house for the first time, and then you proceed. Another major one is if there is a storm that came up, like you put up your purchase agreement today, you are purchasing after 30 days. In between, there was a big hail that came up, or there was a big storm that damaged the backside of the house. So all those things are seller's responsibility. You are supposed to get the house in the condition you saw the house on the day when you had put uh, 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 your offer, right? And that's what you are paying for. So talk to your realtor and make sure house is in the same condition, and then sign final documents. So that covers your home purchase process, and this is the closing day. So normally walk through what we plan is a day before closing, but on the day of closing, you need to sign final set of loan documents. Then your lender will wire money to the closing company, title company, or attorney, whoever in your, depending on your state, who is facilitating this whole closing process. Then your ownership is transferred. You sign all the deeds and all other documents. You get a copy of it, and then you receive your keys. Nowadays, since Corona, since COVID, people are not giving keys to each other. They just leave the key on the house and maybe leave their lockbox and give you the code. You go and get the keys from there. In that scenario, make sure that you change the locks or the keys, at least depending on. If it is electronic lock, then it's easy. If it is not electronic, then don't save those $50-$60. Go buy another set of locks and do it. There are many companies, they can rekey your whole house for $75 to $80. If you need any help, you can always call me. Okay, so now that was our whole home buying process. Now let me cover a little bit about rental investment. And I will have a detailed webinar for rental investors, and I will tell you exactly how it is a good time to buy right now after all these ICE things that happened in Minnesota, how market is opened up for investors and how you can invest more and more money. So just to give you an example, if you purchase a house for $350,000, ideally you can buy it anywhere if you put more than 15% or 20% down. But I personally recommend 25% down. That's where you get the maximum benefit out of your loan if you are taking a loan. Because at 25%, I can get you a very, very good rate that I can't get you at 20% down. 20% down rate would be like at least 1% to 2% more than what you get when you put 25% down. And now, suppose in that house, your rent is $2,800 and your total mortgage is $2,300. So the difference is called cash flow. When somebody says, hey, my cash flow is $400, that what they mean is their total expense per month versus their total rent, like they're making $400 or $500 in between. If you don't want to use your personal income, you want to go for a program who can give you loan against your rental property, that's called DSCR. So going forward, when you hear the word DSCR, you should understand that they are talking about an investment property. And DSCR stands for debt service coverage ratio. So basically, I can get you a loan for any DSCR which is more than 0.5, but 1.0 means 1 or 1 plus is considered good DSCR ratio because you are making more money than your monthly spend. That's what basically it means. So they calculate some ratios about how much money you are making, how much you are spending per month. If that ratio is more than 1%, then you get qualified and you get very good rate. Remember, DSCR rates will be more than your regular normal full doc rate. Means if you are buying a property against your income, you may get, like right now I'm doing at 6%. Investment loans are at 6 and regular loans are at 5 or less. So in case of DSCR, it will be above 7, like 7.125, 7.375, like those kind of rates. Okay, always ask for APR. Don't forget about APR when you are dealing with a loan officer. Okay, I will try to cover a couple of more slides real quick. And believe me, you can text me anytime. I don't mind. Send me a text. If you have any question after this webinar, send me a text or shoot me an email, call me, and I will try to respond as soon as possible. Now, common mistakes to avoid. When you are in a loan process, when you are purchasing a property, don't open any new credit cards. That will cause issues. Don't get a big deposit, suddenly a $20,000 coming from somebody's account, or even within your account, from one account to another account. Just try not to do that, because an underwriter will be asking 50 different questions and then you will have to explain and things get delayed. Another thing we like you to avoid, but if you have to, is job changes. So when you are in a purchase process, and if you are changing your job, then your job verification will change, your income will change, a lot of things will change. So your process will start again, and that may delay your process. Don't skip any inspection. I asked multiple times. I'm requesting you, don't skip any inspection. Always do your inspections, home inspections. And last but not the least is buying beyond your comfort level. If you are with me, I will not let you buy beyond your comfort level. I will do all kind of calculations. I will make sure that you understand your monthly your monthly expenses. I will make sure that you have taken your future into account. If your kid is going for some kind of summer classes, you should know. If your kid is going to college and you have to put a big down and you have to send uh, monthly expenses to your kid, you need to think about all those before you buy a house. See, keeping that one extra bedroom which is empty is not a good idea if you are not able to take care of your family, right? So that covers what you should not do. And now the final slide I have is your clear action plan. I have a couple of questions. I will go through that in a minute. So your clear action plan. You know your numbers. That's what we just discussed. You get pre-approved early. Talk to a guy like me who can get you pre-approval. Then you choose right loan product. You understand how much down you are going to make. You are going to put. What will be your interest rate? It can vary, but still you should get a fair idea. And then you work with the right team. You need to work with a realtor who knows your area. You need to work with a loan officer who cares about you. And then at the end, you buy with confidence. Like on the day of closing, you should not have any doubt in your mind that my realtor didn't do well, my loan officer cheated me, my inspector did not give me good inspection report, or my insurance company has overcharged me. You should not have any of these thoughts in your house. That's what I try to make sure, that when my clients are at closing table, they are happy about their house. They are thinking about what kind of furniture they have to put in the house rather than thinking about what document they signed and if a guy like me has cheated him. So that should not happen, right? So so for that, you can always call me with any questions you have. And let me see these last two questions before we all drop. So this question is from Neeraj, and he has a question about buying beyond comfort level. So he is asking, if I buy a house, means right now market is good, and if I buy a property which is beyond my comfort level, very soon rates will go down and it may come to my comfort level, as well as I will get more equity from that property. Okay, it's a very good idea that you thought that way. Rates will come down maybe 0.5%, but there is a big story behind it. You can always call me. I will explain how, when the rate goes down, there is a refinance cost. There are some charges that you have to pay. So it's not that simple that you wake up in the morning and you think, okay, my rate was 6%. Now it is 5.5. Let's call Prakash and tomorrow my rate will be 5.5. It's not that easy. Okay, you have to go through the whole refinance process. You have to pay for the closer, you have to pay county tax in Minnesota. In some states you don't. And then you have to pay for appraisal. Most probably you have to pay for appraisal, you have to pay for lender fees. So all those things also come into picture. If you really want to make a strategy, call me. We can divide your finances in such a way that if you need a 2-bedroom house or 3-bedroom house, buy a 3-bedroom house as a primary home. If you have extra money, you can always go for a secondary or investment property which is separate from your primary, which will give you more money. You can always refinance your secondary property also, and you can get money out of it. From your own primary home, if you are keeping that 2 extra bedroom which you are not going to use in a year, that's not going to give you any return. Yes, it will go up in equity, but the same with your rental property. So like that, there are so many different ways of handling this situation. You can always call me and I can help you. Okay. And the last question is from Karthik. Okay. So Karthik is asking, what will be a good number for me to purchase a townhome? Okay. Okay, maybe Karthik, you want to ask what is a good number in, and I hope you are from Minnesota, if I remember your number correctly. What is a good number for a townhome? If it is your first home and you are not too much into, like, I'll buy new, I will not buy any used house or something like that. If you don't have that kind of a stigma, uh, in goods, what a lot of people call it a good school district, not me. In a good area, you can find a 2 bedroom for $230,000 to $240,000 right now, and 3 bedroom is somewhere in around 280 to $300,000. So that's the ballpark that you have to keep in mind. And your mortgage, the total cost will be somewhere around $1,700 to $2,000 per month. So that's where, because I do a lot of investments and I know these are the areas where people are interested in and they buy townhomes. If you are buying a townhome which is 15, 20 years old, which is still which will be in very good condition, and later when you decide you want to go for a single family, a bigger house in a bigger area or near your friend, then you can always rent out townhomes. Townhomes are easy to rent. Single families are rentable, but townhome is easier. That's what I meant. Okay. With this, any other question from anyone? I hope you guys liked it. For your privacy, I kept my chat uh, disabled, but because then other people will see your name, and that's not good. I've seen some horrible stories. But if you had any additional questions and you could not talk to me, or you wanted to talk to me, you can always call me at my cell. My phone is always on. You can send me a text anytime, day or night, even 4 a.m. in the morning. And I will try to respond to your questions as soon as possible. So, with this, I would say thank you all for joining, and I hope to talk to you soon. Thank you.